Hi, welcome to Retiring Well. Folks, we got a great show lined up for you today. We're going to be talking about those indices, or what we call indexes, that you follow when you're tracking the market. What are expense ratios, as it has to do with mutual funds, right? Federal Reserve, you hear a lot about them. You ever wondered what their role is? Emotional attachment to stocks, why that may be good or bad. And then surviving spouse taxation, what does that look like? So folks, stay tuned. We have a lot for you.
Retiring Well, brought to you by Centennial Wealth Advisory, financial advisors specializing in retirement planning and serving all of Northern Michigan. Retiring Well, helping you plan for a successful and comfortable retirement. Retiring Well, plan to retire well.
Hi, listen, in this segment, I want to talk to you about indices, or what we call indexes. These are indexes that we track when we're trying to see, what the market is doing. Now, the one we most common is the S&P 500. Now, this is just simply the largest 500 companies in the U.S., okay? It actually has 505 stocks in it because 5 of them have 2-class shares that it follows, but for the most part, 500 companies. It's a weighted index, meaning those stocks that have greater value have a greater weighing in the index. So if you've got a portfolio of large company stocks, that's probably a good benchmark you're going to want to follow. There's also another index called the Dow Jones Industrial Average. Now, this is just 30 large company stocks. They're picked by a committee. It's not a weighted index like the S&P 500, and it's not necessarily all industrial stocks. That's what it might have been in the past. That's no longer reflective of that index. Now, some don't like to use maybe the Dow because it only has 30 stocks in it, but it's one you can follow. Then there's what we call the NASDAQ. Now, this is just it's called National Association of Security Dealers Automated Quotations. Okay, now long name, but for the most part, a lot of people follow the NASDAQ if they're interested in following technology, because what makes up most of it is technology and internet stocks. Now, there's others such as financial and that, but for predominantly mostly technology. Now, this index has 3,300 stocks in it, okay? And again, mostly tech stocks. It is also a weighted index, very, very similar to the S&P 500. So again, if you're somebody that's, trying to follow all these new stocks with technology, that would probably be a good index to follow. Then there's what we call the Russell 3000, okay? This is just 3,000 stocks in the U.S. If you put all 3,000 in, it probably makes up 98% of the whole stock market. So if you're one just want to follow the whole market itself, that might be one you might want to follow. Then there's what they call the Russell 2000 index, okay? That's just basically the bottom 2/3 of that Russell 3000. Okay, so you take the 3,000 stocks, take the bottom 2,000, and that's your Russell 2000. Now, mostly what's in the Russell 2000 is your small company stocks. So if you're somebody that's got a portfolio made up mostly of small company stocks, that would be the index you want to follow. And then just remember, you can get ETFs that own those indexes, okay? One for large company stocks, S&P 500 would be SPY, SPY is the ticker symbol. Or if you're trying to follow, like, let's say the NASDAQ, it would be QQQ is the ticker for that. So hopefully you found this valuable. People follow these indexes, are trying to figure out what the market's doing, and I thought it'd be helpful to know, what makes up them.
Well, I hope everybody out there is paying really close attention to that. That was a great segment, Larry. Indices. You see them all day if you watch the TV, if you're watching the nightly news, the market update. They always talk about usually the Dow, maybe the S&P, maybe the NASDAQ. When you're watching the little ticker in the bottom right of maybe a particular station, they always usually have that running throughout the day. But folks, don't get trapped looking at just one indice. Let's say the Dow is an example. You may be looking at that during the day and you notice, it's up 1%, and then you look online at your account and maybe it's up only 0.5%, or vice versa. Maybe your account's up more than that. Folks, if you're diversified, you have several stocks, several indices, several mutual funds. If you have bond funds, if you have cash, gold, it's not going to follow that. Those are 30 stocks in the Dow. I think it can be really confusing for people when they start just looking at one index and they forget there's other stuff out there you can invest in.
Yeah, Art, I love it when people come in and they go, hey, the Dow just did this, for the day. That's the one they follow. I don't know if that's the appropriate appropriate benchmark they need to be following regarding their portfolio or not. But knowing which one is probably more reflective of your portfolio is going to be a good thing for you to know. I talked about that Russell 3000 making up probably 98% of the full market. If you want to know how everybody's doing, that's probably the one to follow, right? But that's not the one you see usually when you're looking at your browser, right? It's usually NASDAQ, Dow, and the S&P 500. If I'm somebody that has a portfolio that's made up of mostly small company stocks, I'm probably going to want to follow the Russell 2000. That's going to be more reflective of, how my portfolio is doing compared to that. If I am somebody that's just predominantly in large company stocks, I probably want to be following the S&P 500, because that's the top 500 companies in the U.S., right? So, folks, knowing what benchmark to follow that's more reflective of your portfolio, very important to know. Now, we actually have the tools to get behind any portfolio you have, see what your composition is between small cap, mid cap, small company stocks, and basically find out how you compare to maybe some of those other benchmarks. So if that's somebody like you that wants to know that, give us a call.
Hi, my name is Jack Clunner and I'm a financial advisor with Centennial Wealth Advisory. My wife and I moved up here 13 years ago, and we have really enjoyed raising our 4 children in the beautiful northern Michigan country that we have. If you've been watching the show for a while, you know what we specialize in. If you are at retirement or near retirement, give us a call. Call the number on your screen. We can help go through all the different aspects of planning that are involved in retiring well. So I look forward to hearing from you.
What are these expense ratios you find in mutual funds? An expense ratio is simply the general and administrative costs associated in running that mutual fund. It's their research costs. If they're running a fund and they've got an objective, then you want them doing the research as they study the companies and securities that they're putting in that mutual fund, right? It's their advertising costs. Folks, these costs are generally published in the prospectus that they have to give you. That's that little booklet that's got all the details about that mutual fund. What is its objective? What kind of securities is it holding? What's their strategy, right? And in there is going to be this expense ratio that they're going to tell you what those costs are. Now, in 2013, Morningstar did a study and they found that of all the mutual funds, they pretty much averaged about 1.25%. Now you're going to find sometimes mutual funds with much lower costs, especially if there's not a lot of trading associated with it, and you might find some that are higher, but they found the average to be about 1.25%. Now Barron's did a study in 2013 as well, and they found out of 1,800 mutual funds that they found this study did, they found that where the average expense ratio was 1.19%, the corresponding hidden costs were 1.44%. So, you ask, what are these hidden costs? Well, they're going to be the transaction costs associated with the buying and selling of the securities within the portfolio. You got to understand, when they go out and buy a security, there might be fees and commissions associated with that buy. And the same thing on the sell side. Well, those costs aren't going to be disclosed separately. They're just going to get attached to the securities they're buying and selling. So, just knowing that those costs are there is something you're going to want to know. Now, how do I know how high those costs are? Well, you're not going to know. But one clue might be if you look at the turnover ratio with that mutual fund, meaning how much buying and selling they're going to do. Well, there's reason to believe that one that's turning over much more is probably going to have higher transaction costs than one that's not turning over a lot. So folks, we can get behind these mutual funds and we can tell you, what the average expense ratio you're paying is in your mix of mutual funds, and we can tell you what those turnover ratios are within those funds. Isn't that important for you to know? Now, other things we can look at is cross-intersection. When you got mutual funds all owning maybe the same security, when you put those mutual funds together, what securities am I owning? Is there any low concentration of stocks in any one area? So folks, if that's something you want to know, if that's something you want to understand, then give us a call, because we can do that for you.
If you're retired or soon to be retired, let us help you plan to retire well. Centennial Wealth Advisory specializes in retirement planning and has offices in Traverse City, Cadillac, Petoskey, and Gaylord. We'll never pressure anyone to become a client. Our goal is to inform and educate. Simply schedule a meeting at one of our Northern Michigan office locations for a free, no obligation retirement review.
All right, in this segment, I want to talk about the Federal Reserve. Now, you hear about them in the news a lot. It seems like, when they're lowering interest rates, the markets are going up, and when they're raising interest rates, the market's going down. Why are they responding so sensitively to what the Federal Reserve does? Well, there's a lot the Federal Reserve is responsible for. Now, they were created in 1913. Now, there was a lot of discussion at that time whether they should be a private organization or a government organization. And there was a lot of controversy on Congress which way they should go. In the end, they ended up compromising. The board of the Federal Reserve is made up of government appointees and also CEOs of private large central banks. So it's a little bit of private and government in the mix. Now, what is their objective? What is their goals? First of all, they have a dual mandate. They want to, one, keep currency stable, make sure our currency is stable in the country, but they got a dual mandate in the sense that they want to control inflation and have low unemployment. Now, these two things are kind of opposed to each other, because typically when you've had very low unemployment, inflation will go up because people's wages grow and there's higher demand than there is supply, and prices go up, and they don't want inflation to get out of whack. Now, they like to see inflation be about 2%. Now, we've actually had that for quite some time. So how do they do this? Well, they control the money supply by buying treasuries, okay? If they go out and buy treasuries, they're basically increasing the money supply because they're putting money into the economy. But they can contract that money supply by selling securities, okay? So that's how they kind of do it. The other way they control the economy or the money supply is in the interest rates they charge. They become the bank to the banks. So when the banks need money, they borrow it from the Federal Reserve. Well, the Federal Reserve will loan it out to them at a certain interest rate. All right, that kind of becomes the baseline. So if the Federal Reserve is wanting to lower interest rates to fuel the economy a little bit better, then they're going to lower that federal rate in which they loan to the banks, which allows them to loan it out to everybody else at a lower rate. Okay, but here's all that being said, in trying to control the money supply, the biggest goal or objective for the Federal Reserve is to make sure there's no run on the banks. Okay, if you've ever seen that movie, it usually comes out at Christmas time, called It's a Wonderful Life, with George Bailey, maybe played by James Stewart. Remember what happened? All the people came to the credit union and they wanted their money right now. And James Stewart or George Bailey had to tell him, listen, your money's loaned out with this person, it's loaned out with that person. I can give you some of it now, but not all of it. That's what the Federal Reserve does to all the major central banks, so that there can't be a run on the banks and have it be detrimental to our economy. So hopefully it just gives you some tidbits about the Federal Reserve, maybe helps you understand a little bit about their role, which happens to be quite huge. Well, anyway, I hope you found that interesting. Hey, if you want to talk a little bit more about the Federal Reserve and maybe the impact it might have on your portfolio, then certainly give us a call.
Wow, two information-packed segments there, Larry. I mean, when you talk about the Federal Reserve, expense ratios, a lot of numbers and stuff there, but expense ratios, folks, I want to talk for a second about that. if you don't know what you're paying behind the scenes for your investments, let us know. We want to help you make sure you understand that. Fees often aren't fully transparent. Oftentimes, you get these stacks of prospectuses in the mail. Well, in there, they discuss some of those fees, but how often are you reading through all those? Just the other day, Larry, I had a gentleman come in and he talked about how he likes getting those, not because he reads them, but this time of year he uses them to start fire in his wood-burning stove. And that's not what they're intended for. You should be looking for those expenses, understanding what you have. But if you don't know, this is where we'd like to have a free second opinion meeting with you. Get behind that. See what you have, see what risk you're taking, all that sort of stuff, see what your plan is, but to help you understand what those fees may be.
Yeah, Art, I just wanted folks to understand these expense ratios because, it comes off their return. They don't see them. They certainly don't see the hidden costs. So, a lot of people are paying fees, have no idea they're paying fees, but it's relative, right? And then when I was talking about the Federal Reserve, I mean, with this pandemic, the Federal Reserve is basically throwing everything up at the kitchen sink to try to, keep this economy chugging along. I know of recent weeks they were calling for the government to do a stimulus package because they're concerned, especially with this second wave we've had with the pandemic and the coronavirus. Very critical. But I thought recently they've always had this mandate to try to get inflation in check at about 2%. And of recent they've called for higher inflation. They think because we've had such low inflation for so long, we can have a little above average inflation for a while to kind of make up for that. But honestly, when you got higher inflation, that's not good for the economy overall because people have less purchasing power, less consumer spending hurts our GDP, which hurts the market overall. So I think the Feds are going to continue to try to do everything they can, but I thought it important for you to understand what their role is. So folks, hopefully you found this valuable. Stay tuned because we got more for you.
Hi there, my name is Nick Greenman. I'm one of the financial advisors here at Centennial Wealth Advisory. Brand new to the Gaylord office. I'm here full-time now and also be commuting back to the Petoskey office as well. I'd love to hear your story and learn if I could help you manage your retirement needs.
In this segment, I want to talk to you about maybe having too much emotions with the stocks that you own. I think of the story of my wife's grandma. She inherited this stock from her parents. It was Dow stock, and it was all in one stock. It was all in Dow. And she wanted to pass that on to her kids. So what she did, though, is she kept it all in Dow stock. She felt like that because she received it as Dow stock, that's what she wanted to pass on. Now, I had to explain to her that, we might want to challenge that thinking because being all in one stock, if that stock went down in value, that account was going to go down in value as well. She had no diversification. So even though she had this emotional attachment to it because it was given to her and she wanted to pass it on, it wasn't necessarily the best thing for her to just hold on to it. I think of that a GE literally was a rocket scientist for GE, and GE had always done him well. He'd worked for him for years. He'd actually retired from GE, and he owned all this GE stock. Now, GE at one time would be a tremendous company to have ownership in. Of recent years, not so much. But I had a heck of a trying to talk him out of getting out of his GE stock because he had such an emotional attachment to it. Now, did it do well for some time after that? Absolutely, it was a good thing for him. But had he held on to that, again, in recent years, would not have been a good thing for him. I think that individual, when .com was such a big thing, this is in the late 90s, remember, right before that recession we had between 2000 and 2002, and he was hearing about all these .com companies. He got a hot tip on a couple of them that were doing very, very well, but they had no earnings. And I was trying to explain to him, listen, this is not stocks you want to own when they don't have any earnings. And he wanted at one point to put everything in them. I talked him into only doing about 10%. Well, sure enough, what happened? Earnings did matter. That those stocks lost all their value in that recession, and he was so happy that he didn't throw all his eggs in that basket. Folks, earnings do matter. You know, the market trades as a general rule at a multiple of its earnings. Historically, it's traded at about 17 times earnings. So when we see that multiple get a little bit higher, let's say it gets up there around, 25, we can sustain that for a little while. And some people will jump ahead and do that because they see the earnings doing well in the future. So you can stand that. But folks, it's not going to be sustainable for long periods of time. Diversification is still the answer. You want to, again, don't want to have all your eggs in one basket. Don't get yourself caught emotionally holding stocks that you shouldn't hold. If you're somebody that has that concern and you want to see what proper diversification looks like for you, then certainly give us a call. We'd be glad to help. We here at Centennial Wealth Advisory realize that everyone has been affected by this coronavirus in one way or another. We watch our retirement accounts drop significantly in value, and we have questions. Can I retire in a recession? How will the coronavirus affect my retirement? How do I develop an income stream in a recession? Can I still retire this year? If these are concerns of yours, contact us today for a free initial consultation and learn what you can do now to help you weather the storm. Simply call 888-608-5825 or visit sunwealth.com and let us help you plan to retire well. Hi, welcome to Chalk Talk. Listen, what I want to talk to you about in this segment is surviving spouse taxation and why it's so important to understand. So here's a couple. They're getting $45,000 in Social Security. Now just don't know this, one's getting 30, the other's getting 15. Now they want $81,000 of income. So they're just going to take $36,000 out of their IRA to make up the difference. Now Uncle Sam says in this particular case, $18,000 of that Social Security is going to be taxable income. Now they get a standard deduction for $26,000. Okay, their taxable income is $28,000. Income tax, $2,992. All right, now one of them passes away. Now, if you didn't know this with Social Security, the surviving spouse gets to keep the higher of the two Social Securities. So he or she gets to keep 30, but they lose 15 in Social Security. Now, he or she still wants the same income of $81,000. So now all they're going to do is take an additional $15,000 out of the IRAs to make up the difference. Now, Uncle Sam says in this particular situation now, okay, look at this, $30,000 in Social Security, but now $26,000 of it is taxable income. Look at the difference. Over here, $45,000 in Social Security, only $18,000 of it was taxable income. All right, so they get a standard deduction that's half the amount they had before because they're single now. Okay, taxable income, $63,000. Income tax, $9,890. Now folks, understanding this is very important. Why? Look at the difference here. A difference of almost $7,000, and all he or she did is take an additional $15,000 out of the IRAs to make up for the lost income they lost from Social Security. How can this be? So understanding what that taxation is going to be to the surviving spouse is just as important as it is when you're both together in your married years living. Maybe we could have employed some IRA exit strategies like being more aggressive with the Roth conversions. So by the time that person died, and there's a surviving spouse, none of the Social Security ended up being taxable. Maybe we could get them into a situation where they had zero tax at all. Again, no cost, no obligation to come in and let us see if you're a Roth conversion candidate, maybe show you what your situation looks like. Give us a call. You know, when I talk about having an emotional attachment to stocks, you know, I'm guilty myself. Oh. You know, I have 2 sons that work for UPS. One is a head of HR, the other is a driver. And so I hold UPS stock, and every time I look at UPS, I'm thinking of them, quite honestly. So, and I actually joke around with them if the UPS stock happens to be down. I call them up and say, hey guys, what's going on here? You might want to step it up a little bit because my stock's going down. So, you know, we can have these emotional attachments to stock, but you know, if you have to have them, then at least find ways to protect yourself, right? There's a couple different ways we can do that. Maybe put a trailing stop loss on it, right? You know, set the market which you're okay losing, and then just, you know, let's say that's like 20%. You know, that's the most I'd want to lose. Put that on. So if it goes up, continues to go up, I ride that up. But if it should ever drop more than 20%, it's going to sell off. That would be a good thing. I've talked about in other segments about options. You know, maybe you might put some options to protect yourself. It's almost like an insurance policy against that stock. So folks, if you have to hold that stock, at least find some ways maybe to protect yourself.
No, absolutely, and that's interesting, Larry. You know, that's one of the dangers of self-managing, right? Is you get emotionally attached. You know, Larry talks about UPS. Some folks I see get attached because the stock's done well. Oh, they've done so well for me, I have to keep holding them. You know, even if the fundamentals don't make sense. And then you brought up a very sensitive subject with surviving spouse tax planning. You know, it's nothing anybody wants to talk about, but folks, really important to be doing. You know, if you're married currently, you know, and think about eventually down the road, if one of you is either predeceased, the other person, there's some pretty big tax consequences to single people. And if you got IRA accounts, pre-tax accounts, boy, you could get beat up pretty bad. You know, you can go from being in a pretty low tax situation, you know, in shows past, we talked about how Social Security is taxed. Boy, in a single person, that, you know, that can really make a big difference and stuff. So really pay attention to that. If you haven't had that planning, don't have a surviving spouse plan, let us know. We'd be happy to help. And folks, we just want to wish you a happy new year here from all of us at Centennial Wealth Advisory and Retiring Well. In this season, and Retiring Well here, this is our 10th anniversary. We've been on air now for 10 seasons here with Retiring Well, bringing you hopefully valuable retirement information, investment information. And if you want to learn more about us or go back and see some of those original shows, go to our website at cen-wealth.com, and there's a lot of history there. Looking forward to bringing you more exciting stuff this year, wonderful information, and helping hope you retire well.